In a week when we learned that Britain has finally returned to growth, Bill Gross, who runs the world's biggest mutual fund at PIMCO, took the opportunity to say that the UK is a must to avoid. Well, still, he says that gilts are resting on a bed of nitroglycerine. Harsh words for Britain's bond investors, but one man coming to the country's defence is the chief executive of Charteris. He's Ian Williams. You're not going to welcome those comments, are you here, Ian? I mean, what do you make of them?
Well, not really. I mean, our view of the gilt market is that it's a lot more sanguine, and we feel that the gilt market is probably okay this year.
Where's there any value in it, though?
Well, our core case is built around that the UK, when it emerges from recession, will have very anemic growth, less than 1%, not just for this year, but going ahead for the next 3 or 4 years.
So rates stay at these levels for how long?
Well, for at least all this year, plus a bit more. I mean, we would attach a 50% probability to that. We would attach a 40% probability the economy goes back into recession, and you may even get further cuts in interest rates.
Well, how much can they cut them down to?
Well, I mean, they can cut them to a quarter, they can cut them to effectively zero, or they could even possibly go.
Surely that's a very, very small chance of that happening.
Well, the reason we think that is that there has to be an election, which we think will be on May the 6th. All three parties are committed to halving the budget deficit once they get in. The UK economy is showing the weakest growth of all the major economies around. How can you cut the budget deficit in half and end quantitative easing and avoid the economy going back into recession? It looks almost impossible to us.
Let me give you the alternative scenario then. You printed all this money with this policy of quantitative easing. When you print money, you invariably get inflation.
Well, the narrow measure of the money supply has doubled. The wider measure of the money supply has fallen. I mean, it's almost unbelievable that they pumped 200 billion into the system, into the banking system. It's worrying though that and nothing has come out the other end.
Well, that's what I'm saying. 200 billion pounds are put in there, and then we're talking about 0.1% growth.
Yeah, exactly.
Where would it have been without all that money being pumped in?
You'd have had a much steeper recession. I mean, if you look at the effects of quantitative easing, it was introduced in March. The FTSE was 3,600, and the 10-year gilts were yielding about 365. They've pumped 200 billion in. The FTSE has gone from 3,000, has gone up 50%, and the gilts have fallen in price. The yields have risen to around 4%. So 200 billion of quantitative easing has not benefited the gilt market at all.
That's what I'm saying. Where's the attraction in gilts?
So if they reverse quantitative easing, if quantitative easing ends, it's not impossible that what happened when quantitative easing was introduced goes into reverse. So the problem may well be in the equity market, not in the gilt market.
Okay.
See what I mean?
Oh, right. Well, let's change countries now and take a look at the Fed coming out and saying that the US in recovery. Okay, it's not all good news for investors, though. It's going to start perhaps unwinding its purchases of asset-backed securities here as well. Yeah. So the unwinding there, does it have a different outcome?
Yeah, I mean, the US is in slightly different in that its probably growth prospects are probably better than those of the UK. It's not going to have an election within the next 3 or 4 months, so the Obama regime's got a sweep at this for the next 2 or 3 years. So the US and the dollar's had a huge devaluation. So the US is probably better placed to see a bit of economic growth than the UK. I mean, whichever way you dress it up, the UK is going to be at the bottom of all the growth leagues for quite a long time, I would have thought.
Now, you also manage the City Financial Strategic Gilt Fund as well. Now, that's done very well since, I mean, I think Lipper said it was the best performing gilt fund since its launch in 2006. Correct, What sort of growth are you targeting for it this year?
Well, it's averaged about, since it was launched 3 years ago, it's averaged about 8% a year. This year, we think it could quite easily manage a similar, maybe 6-7%. That's that sort of area. But then we're not as bearish on the gilt market as a lot of other people.
Ian, thank you very much indeed.